So why is it then that these behavioral biases persist? That takes us to our next discussion of limits of arbitrage. Now, it sort of follows that if investors, some of them at least, are susceptible to these biases, why wouldn't an arbitrageur be able to take advantage of whatever mispricing these biased investors introduce and actually make prices efficient, thereby resolving the Grossman-Stiglitz paradox, because the investors then, the biased ones, are the source of inefficiency, and their presence is the source of profits for arbitrageurs, who can actually then make the market fully efficient again by trading against the biased investors. Well, so there's a few reasons, and they all fall under the umbrella of limits to arbitrage for why this may not actually occur. In other words, why even in the presence of investors who are not susceptible to behavioral biases, who could potentially trade against behaviorally biased investors, why the market still may be inefficient, mostly because these arbitrage trades may be hard to pull off for several reasons. So the first of these is fundamental risk. And this is perhaps best described by a famous quote by Maynard Keynes, who said that markets can remain irrational longer than you can remain solvent. So in other words, you can be right, but if you bet against an irrational market, you also need to be right within a certain span of time. And if you're not, then that means that you might still actually end up taking a loss simply because there's more irrational people out there that'll keep pushing prices away from whatever the no arbitrage value is, longer than you can sustain whatever trade you had in place to take advantage of this eventual repricing. So a great example of fundamental risk is why people are hesitant to short asset bubbles. Oftentimes, for example, in the dot-com period, or in some cases, really during any period of economic boom, prices for certain risk assets will seem completely unjustifiable. A firm will have sky-high multiples. It might even be a loss-making firm. It could, as in some of the trades during the pandemic recovery in 2020, were literally trades in bankrupt firms where the likelihood of payoff for the long investor was very low. Think about Hertz, for example. But does that mean that it always makes sense then to short and to bet against whatever these overvaluations and euphoric sentiment by long investors is? Well, not necessarily, because you don't really know how long it'll sustain. And as price keeps moving up, a short position will, of course, continue to lose money, and an individual arbitrageur is much more likely to run out of capital on their short position than the entire rest of the market that is driven by perhaps misguided euphoria, but they just have a larger capital pool to keep driving prices up than an arbitrageur potentially has to bet against that rise. So that's sort of why, even if there is a seemingly obvious rise in prices that is above reasonable levels, fundamental risk, this idea that convergence between intrinsic value and market value can take too long to happen, that may actually keep people from betting against this irrational rise too aggressively. And furthermore, implementation of any sort of arbitrage trade does involve transaction costs, potentially also restrictions on short selling. So some shares, like for example, Hertz, a bankrupt company that really did have seemingly drastically overbid shares because the firm literally has gone into bankruptcy, but investors were still bidding up the price of its quite likely worthless shares. Those shares would be hard to borrow to short, either impossible or at least only at the cost of a high fee. And that would sort of pile on top of the fundamental risk of, well, how much longer is this euphoric sentiment going to sustain? If you not only have to contend with a potentially continuing rise in prices before they finally fall, but you also have to keep paying a potentially high borrowing fee to do so, that can, of course, place an even greater limit on the willingness of rational market participants to try to trade against euphoric sentiment in many cases. The other big limit to arbitrage is simply the potential recognition that you might be wrong. In other words, model risk. That's something that any trader has to ask themselves no matter what position they take, long or short. And that, of course, will limit their position size in any trade. And these arbitrage trades against potentially misvalued securities are no different. So really, model risk is just a limit on positions broadly, and that affects the ability to short potentially overpriced securities or buy potentially underpriced securities as well, therefore limiting the ability of unbiased investors to step in and take advantage of mispricing. And another great one is capital constraints. Because generally, of course, arbitrage is more of an institutional activity, which means that arbitrageurs are likely to be deploying others' capital alongside their own to try to take advantage of mispricing. And that means that this capital is either going to be debt capital that they've borrowed, essentially levering up their own position, or equity capital, essentially money that investors have given them to invest alongside them to profit from these arbitrage trades. And both of these types of capital, either leverage, borrowing, or equity financing, both have constraints. And since there's a limit on how much you can risk either by borrowing from others or by investing their money for them, that also then places a limit on arbitrage activity. A great example of this was long-term capital management, a hedge fund that actually pursued pretty aggressively arbitrage trades. And as part of it, they had, for example, a exposure that was short liquidity. They liked betting on illiquid assets and betting against liquid assets that would otherwise have similar payoffs. And of course, then when those payoffs were realized, arbitrage profits would be made, but only if the arbitrage trade could be sustained. Now, why might it be impossible to sustain a position, either due to a leverage constraint or an equity constraint? Well, it just depends on what else is going on at the time. So at the time of LTCM's failure, when they had this sort of trade on, there were other funds like Salomon and Merrill that had similar positions. And when the Russian default shock of 1998 happened, it actually meant that prices diverged. In other words, the trade moved against the arbitrageur, similar to the example of fundamental risk, just in this case driven by the Russian default shock rather than overall market sentiment. The trade moved against these arbitrageurs, including LTCM and Salomon and Merrill, even more. The problem is that if you borrowed a certain amount, and then it actually turns out that the trade now diverges even more, and in other words, the position that you are long becomes less valuable, the position that you are short becomes more valuable, both sides leading to losses, you may actually then face insolvency as an arbitrageur, because once you hit zero equity, then you have a margin call, and if nobody's willing to lend to you, then whoever you place the trade with is going to liquidate your position. And while the equity constraint is a bit softer in that sense, it's actually no less binding in the sense that, again, if you've placed a long-short trade and the long position starts losing and the short side also starts losing, your equity investors might actually pull their capital out of your fund, causing you to liquidate that position just as though you had received a margin call on a loan. And of course, what this means is that this can then actually cause prices to destabilize even further, rather than having the arbitrageur be able to stabilize them by stepping in and correcting these mispricings by going long the undervalued security that was perhaps illiquid, as in the case of LTCM, and going short the overvalued security that was highly liquid. If there's this rush to liquidity and it bids up the price of the asset that the arbitrageur was short, then the arbitrageur might be forced to unwind their position, either to pay off their creditors if they hit a leverage constraint, or to satisfy the redemption requests of their equity clients if they decide to pull funds. And well, what happens then? You have to sell the position that you were long, and you have to buy back the position that you were short. And of course, selling a long that is falling will just make it fall even more. And buying back a short that is rising will cause it to rise even farther. In other words, the liquidation of a long-short trade aimed at convergence between the long and short positions, if you liquidate it too early, all you'll do is just push the long and short positions farther apart. And that's indeed what happened with LTCM's position in sovereign debt, which actually led to the collapse of that arbitrage strategy and indeed the whole firm, precisely because of capital constraints. So of course that means that arbitrageurs since then, if not before, seeing this example, probably are now even more concerned about not hitting either leverage or an equity constraint, and that places even greater limits on the willingness of arbitrageurs to step in and try to correct mispricing, because there is this very real possibility that if the trade actually keeps diverging for a while before it converges, the arbitrageur could be wiped out, either by hitting a leverage constraint or an equity constraint. So here's an example from the coronavirus pandemic trades. One of the first COVID vaccine hype trades in a firm called Moderna, who first proposed the vaccine candidate. You can see how prior to the pandemic in February, they were trading at somewhere around $20, and then they shot all the way up to 80, and then later on even higher than that. But it's worth sort of thinking about what might be going through the minds of investors at around this time in mid-May of 2020, when this company is literally appreciated fourfold. It has actually no positive earnings, so we can't really think about what its price to earnings is. But we can look at what its price to book is. And in mid-May, it was about 18 times, which is tremendously high. And a rational arbitrageur might think that, well, this is certainly one of the firms that's capable of producing a vaccine, but how likely is the vaccine to actually pan out? Remember, there's this idea of base rate neglect. how likely is it that this potential treatment would actually even pass a phase 3 trial? So there's reason to doubt that this fourfold rise in valuations is justified. But at the same time, do you dare to short this firm at this point in time? Remember, there's fundamental risk. There's simply a lot of enthusiasm behind this potential vaccine candidate, so prices could keep rising, and as soon as you go short, any further price rises will eat into your capital. There's implementation cost, because this is a small firm and it's hard to borrow their stock to short. There's model risk, because after all, how good are you as the arbitrageur at predicting phase 3 approvals? Perhaps they actually will get this vaccine approved, and then if you were short, you would face tremendous losses. And finally, of course, capital constraints, because if you either invest the equity of other people who have lent you their capital, or you invest by borrowing capital from other people in the form of debt, you might end up hitting either a debt or equity constraint if this firm continues further appreciating. And all of this, if we sort of look at what was going on with short interest in Moderna at the time, actually seems to have been a real limit to arbitrage, because we can see, just sort of in terms of total market value of shares, we can see it's rising for a while as this firm starts appreciating, because perhaps there is doubt about whether it's now rapidly gaining valuation is justified. But after it pushes past a certain level here in mid-April, we actually see short interest declining. And indeed, it seems to hit a bottom just as valuations, at least in terms of price to book, hit a top. So in other words, if you thought this firm was overvalued in mid-April, surely it's even more overvalued in mid-May. But at the same time, you may be much more hesitant to bet against it in mid-May because sentiment seems so high, and there is room for doubt in terms of what might actually happen down the road. So this is an example of seemingly a pretty high limit to arbitrage, and that's the sort of thing that keeps even rational investors from being able to fully close misvaluation due to behavioral biases. So that's sort of why behavioral biases may persist even in the face of arbitrage capital. And these limits to arbitrage can then actually result in fairly blatant violations of the law of one price that we remember from arbitrage pricing theory, sort of showing just how powerful of a force they themselves are, even in the face of seemingly irrational markets, why these sorts of mispricings can persist. A famous anecdote is the dual listing of Royal Dutch Shell in the States and in Europe, where the two firms merged in 1907 with a 60-40 profit split. In other words, the total cash flows earned by both firms would just be divided at a ratio of 1.5 to 1, 1.5 going to Royal Dutch, 1 going to Shell of each unit of income earned. Now, of course, if this profit split is as sort of set in stone as it is under the terms of the Royal Dutch and Shell merger, it should be pretty obvious what the limit to, or what the appropriate price ratio of the two assets would be one to the other. How could Royal Dutch trade at anything more than 1.5 times the price of each share of Shell, if the cash flow rights are literally 1.5 times each share of Shell for every share of Royal Dutch? So there really isn't an issue of, let's say, model risk in this valuation. It's just literally is it different from the ratio specified in the merger agreement. And yet, if we sort of look at the deviation from this ratio implied by the profit split, 1.5 to 1, we can actually see that Royal Dutch was trading at a substantial premium to this 1.5 to 1 ratio for a relatively long time in the 90s and all the way up to 2000s. And why would this persist? Well, primarily because of fundamental risk. In other words, yes, you could make a trade against this if Royal Dutch were actually trading at a greater premium than 1.5 to 1 relative to Shell, which it was. Well, of course, what you would want to do is you'd want to short Royal Dutch, and you'd want to go long Shell. And then presumably, over time, Shell would appreciate, Royal Dutch would depreciate, and they would then start trading at around 1.5 to 1 again. And indeed, if we look at the price path, over time, that is what ended up happening. The problem is with fundamental risk and the idea that the market can stay irrational longer than you can stay solvent. We can see that really this convergence only happened by about 2001. And in all the time prior, these trades were actually still divergent, and we can see that they actually became even more divergent in about 1998. Now, coincidentally, what happened in 1998? Well, there was that Russian sovereign default. There was this rush to liquidity, so some illiquid bonds actually became more mispriced, more undervalued. Some liquid bonds became even more overvalued. So how does this affect the divergence between two equities? Well, interestingly, LTCM was actually involved in this trade as well. And this is exactly the trade that they took. They bought shares in Shell, which were undervalued. They shorted Shell shares in Royal Dutch that were overvalued. And they hoped that they would converge over time. This was, of course, pre-1998. But as they also had that position in long illiquid bonds and short liquid bonds, as that long short position moved against them and caused their entire portfolio to be unwound, that meant that they also eventually were forced to liquidate this position. So they actually had to sell their shares in Shell, which meant that those shares became even more depressed in price, and they had to buy back their short position in Royal Dutch, meaning those shares became even more overpriced, which actually led to this increased divergence, showing how the unwinding of arbitrage positions can actually lead to greater price instability in times of particular market stress. And furthermore, if you were, for example, in a smaller arbitrageur that was trading the same trade, which seemed like a no-lose proposition alongside LTCM, and you knew that LTCM had this other bond position on, and you knew it was going badly, and this whole thing would have to be unwound, you'd probably want to unwind your Shell trade even before LTCM could do it, because you knew that by unwinding their position, selling their longs, buying back their shorts, this divergence between Shell and Royal Dutch would only widen over time, causing you losses if you held that same long-short trade. So the fact that arbitrageurs know that this sort of misvaluation could potentially persist and even become greater in the shorter term before it eventually does converge in the long term, means that they might be hesitant to trade against a mispricing like this, even though it's an obvious violation of the law of one price. Another one that's sort of famous is a carve-out of Palm from 3Com, where Palm was a subsidiary of 3Com, and 5% of its shares were IPO'd, to great enthusiasm, and then the remaining 95 were essentially going to be distributed to existing 3Com shareholders, with 1.5 shares of Palm going to each for each share of 3Com to their existing shareholders. Which of course meant that if you had 1 share in 3Com, you will eventually receive 1.5 shares in Palm as well. But given this limited IPO and the huge enthusiasm for it, it turned out that these 5% IPO shares actually traded at such a premium that 3Com effectively had a negative value. So if we think about 1 share of 3Com as being whatever 3Com is worth, plus it's got some cash flows, like 3Com was a profitable company, but it also entitles you to eventually receive 1.5 shares of Palm. If we literally look at what the price of Palm in the market is post-IPO, but before these 95% remaining shares were distributed to 3Com shareholders, we would see that each Palm share was so valuable that effectively the share of 3Com traded at much less than the value of just the 1.5 times shares of Palm, much less whatever income 3Com produced on its own. So then what should one do? Well, of course, what one should do if they were trying to make an arbitrage trade is they'd want to go long 3Com, because by buying a share of 3Com, you're eventually going to receive 1.5 shares of Palm. And you'd want to short 1.5 shares of Palm for every share of 3Com that you've bought, because you know you're going to receive that back and be able to satisfy your short position farther down the road. But the problem is that only 5% of Palm's shares were currently available in the market post-IPO, and therefore they were super hard to borrow, so you actually can't short Palm, and so that would be a violation of the law of one price, simply because you can't borrow those shares. That would be a really hard transaction limit to this arbitrage trade. And another one is closed-end funds, which are essentially sort of like a publicly traded investment company. It's like a mutual fund that has bought a certain amount of securities, and then shares in that fund themselves become traded on an exchange. And of course, they can then trade at a discount or a premium relative to the net asset value of whatever the fund has invested in. But if you view the fund as literally just whatever the value of the things it has invested in as it's worth, why would it ever trade at a premium or a discount to its net asset value? But this is a violation of the law of one price that could not only be explained to by limits to arbitrage, but also by some rational expectations about perhaps manager skill. Perhaps the managers of that closed-end fund could actually grow that capital at a rate faster than an investor who just bought those same shares directly could. So that one is perhaps not just a limits to arbitrage story, but surely limits to arbitrage also would play a role in it. So these are sort of examples why even really obvious violations of the law of one price, which is sort of a precursor to there being an inability to make arbitrage profits, even if the law of one price is violated and technically arbitrage profits should be possible, like with the mispricing of Royal Dutch versus Shell or with 3Com and Palm, it's still potentially possible that nobody can trade against this mispricing for a while due to these limits. So limits to arbitrage essentially explain why price deviations from rationality, perhaps driven by behavioral biases like this enthusiasm for Palm, can actually persist for long periods of time without anybody being able to step in to do anything.